Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Major changes to superannuation are on the way, with legislation before Parliament aiming to reduce certain tax concessions on super. The Division 296 legislation would reduce tax concessions for individuals with a superannuation balance exceeding $3 million. If it passes, the legislation would take effect from 1 July next year. The super industry was consulted on the changes, and while these particular adjustments are targeting those with substantial superannuation savings, there's an opportunity here to improve equity across the whole super system. Mary Delahunty is the CEO of the Association of Superannuation Funds of Australia, ASFA, which is a great supporter of this podcast. Mary, welcome to Fear and Greed.
Thanks for having me. It's a pleasure to be here.
So, take me through the Division 296 legislation. We've heard lots about it in recent weeks because they're struggling to get it through Parliament, the government is, but just explain what it is.
It's firstly a great example of how we talk about things in either acronyms or numbers and probably shouldn't. So Div 296, I don't know why we call it this, but here it is. It's a measure of equity. So if I go back really, Sean, to sort of principles, ASFA, as the voice of super, been operating since 1962 to really progress a few key components of the system, of the super system. And we think about Australia's system, it's world renowned, isn't it? So we look at things that have made it such, like equity. So making sure that there's sort of equal distribution of what you were calling those tax concessions, and equal distribution then of outcomes. We also safeguard preservation, making sure that the money stays in there for the purpose of retirement. And we also look to safeguard other elements of the superannuation system that has made it strong, like universality, so it covers all workers. This one goes to that element of equity. So what Div 296 aims to do is put an additional tax on earnings over $3 million. And what ASFA thinks should happen, if we are to do that, is to make sure that that's returned in the system and lifts the lower end of super up.
Okay, so just go further. Firstly, you said 3 million earnings. It's actually 3 million savings, isn't it, rather than earnings, or am I getting that wrong?
Earnings.
So people who have $3 million in their account that they've earned and put it into their super account. Okay.
Yeah, and the tax is on the earnings over that.
I see what you're saying. Yeah.
And but this is a good point to clear up, because it is sort of a confusing point, and we've been having a lot of these conversations with the decision makers across Div 296. Actually, the more I'm saying that, the more it's kind of a catchy title anyway. So
it's pretty good. Yeah, go on.
That we've been having these conversations to explain, yes, firstly, you need to have over $3 million in your total superannuation balance. Maybe you've got two accounts still, something like that. So firstly, yes. And then secondly, it's the earnings over that $3 million that will face the additional tax. So that's one component of it. That's the top end of super. This affects about 80,000 individuals in Australia at the last count.
Yep.
The other element of equity, though, which is really important, when you think about super, it is a tax construct, isn't it? The bargain of it, like the sort of contract between every working Australian and every Australian, is that working Australians will set money aside for the purposes only of their retirement income. And because of that, like if they do that, then they will receive tax concessions for having done so.
Yep.
And that pretty much means that you should be paying less tax for the money you've set aside than the money you've got outside of super. So that's the bargain.
Yep.
That is struck. Fair. If you think about those people earning under the lowest marginal tax rate, there's a few of them, way more than the 80,000 that are affected at the top end, that are going to be paying more tax in super than outside of super. So do you see that for them, the bargain doesn't work?
Yeah. Now, there is the government's, I'm going to get it wrong, it's list. Is that the right term, the offset?
It's called LISTO.
LISTO, sorry.
Again, maybe we'll do another episode on acronyms and how we use it. LISTO is a low-income superannuation tax offset.
Yeah.
What that does is that aims to correct that bargain.
Yeah.
But it hasn't kept up with taxation rate changes. and it doesn't correct it to the point where people are actually better off. So we need some changes to Listo. Those changes would be affordable if we ring-fenced the top end, this tax that's been put on people with over $3 million, and we popped it into the bottom end.
Yeah, and so what you're saying, so you're not against the top end extra tax as such, you just think the money should be used in a better way, i.e. rather than going into general revenue, it should actually go to help those who aren't winning this part of the bargain.
That would be a real measure of equity, wouldn't it? So if one of the key components of our system is to make sure that it's equitable and that we're distributing those tax concessions, because even though they're not, they feel like they're not real, they're very real, aren't they? If you're giving away tax,
totally.
Then you're missing out on public spending. Yep. So we need to make sure that they're equitably distributed. And a way of doing that is to think when you take from the top end that you give to the bottom.
Stay with me, Mary. We'll be back in a minute. My guest today is Mary Delahunty, Chief Executive Officer of the Association of Superannuation Funds of Australia. Okay, so it's kind of a redistribution measure as well as a tax concession. It hasn't made it through the House of Reps yet, though, and let alone the Senate. That's where the legislation's up to?
It's been hotly debated, and there's a lot of discussion, and it's confusing. So it's helpful to have the conversations with you and your listeners about what it actually means and how it actually works, because that helps policymakers understand this as well.
Yeah.
A few of the components of it are a little bit unusual, but that's proper, isn't it? When you're looking at trying to do something that is in a complex tax environment, it's going to look a bit messy until it's not. So we welcome those discussions, but we would like to see the passage of it through the House because it's meaningful for people.
What about the unrealised? I mean, it seems to where it's being held up. It seems to be the unrealised gains. So actually having to pay tax on unrealised gains. Now, an individual, well, they do have to put their hand in their pocket in as much as it's presumably any of those taxes is coming out of the super, which they own, though it's probably not hurting their cash flow pre-65. Is that fair, taxing the unrealised gains or not?
There's been a bit of chatter about this unrealised capital gains, and I guess it's fair. It's definitely fair to analyse it. It's a little bit, I think, disingenuous to suggest that this is wildly inappropriate. When you look at the principle of taxing unrealised capital gains and you sort of think, well, where else is this done? You can pretty well draw a straight line between that principle and land tax. It's the same sort of thing, isn't it?
Yep.
I'm paying land tax on a property that I haven't sold for a capital appreciation, for hopefully appreciation that I haven't realised. That is, in effect, an unrealised capital gains calculation. The other place that this is used is in Centrelink. And isn't it interesting that in the public debate about these unrealised capital gains, we are hearing a lot of noise from people who are asset holders who believe this to be, pretty unusual. But we don't hear the sort of the voiceless in this are the people who have had to do this year after year in order to have their Centrelink benefits assessed. So this is not an unusual construct in the Australian system, but it's never been applied in this sense. So there have been floated other ways of perhaps doing that. One of those ways might be, so you use the same principle, but you're allowed to run a debt with the ATO.
Yep.
That's possibly something that could be explored, but these can be explored in a form of regulations afterwards. But let's get the principle done, that we believe this is it's not an unusual way. It's a little unorthodox in this setting, but a lot of Australians are living under this already, and move forward from that point.
Broadly, Mary, how important is it to get the principles right up front, given the size of the superannuation pool in Australia, it's sort of heading towards $4 trillion, the fact that governments of all persuasions are going to be looking at that and changing the rules in the future? We hope that doesn't happen. In a sense, we need it to be the integrity to be there. But kind of what you're arguing here, the equity argument in terms of, okay, the over 3 million taxing on the earnings, but actually let's use that money for people who need it. How important is it to get those principles right now? Because presumably they become precedent setting for what happens in the future.
Yeah, it's always important to get the principles of a piece of legislation right. There's something else that's being considered in this term of Parliament as well, which we'd like to see go through, which is the objective of superannuation legislation too. The objective of superannuation has like an anchor point for any decision of Parliament that touches the super system to have a statement of compatibility against that objective. That's probably you can see how those sort of things work hand in hand.
Yeah.
Where without that, as you rightly point out, you're sort of wondering, is it form or function all the time in this legislation? Yep. And that would be really helpful too. We think that's a really crucial piece of legislation. And then it's the legislation, but then it's the action that it sets up, which is that. Yeah. So now I must have a statement of compatibility, which is, would go to ease some of these debates, I think.
Yeah. Mary, plenty to chew on. Thank you very much for talking to Fear and Greed.
Thanks.
That was Mary Delahunty, CEO of the Association of Superannuation Funds of Australia, which is a great supporter of this podcast. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.